The United States government created an account that lets you grow your money completely tax-free. No taxes when it grows, no taxes when you withdraw it, no taxes when your kids inherit it. You can put up to $7,000 a year into this account, invest it in index funds, and in 30 years have over $1.2 million that you will never owe a single penny of taxes on, ever. The IRS will not touch it. Not now, not at retirement, not when you die. It is the single most powerful legal tax shelter available to regular people in America, and most Americans either don't know it exists, don't understand how it works, or have been told they'll set it up eventually and never do. That account is a Roth IRA, and in the next 15 minutes, I'm going to explain exactly how it works, exactly how to set one up, exactly what to invest in inside of it, and the exact math that turns it into a tax-free retirement fortune. If you don't have a Roth IRA after watching this video, it's not because you didn't know, it's because you chose not to. My name is Phil, and I break down the money strategies that turn ordinary income into generational wealth. No jargon, no fluff, just the strategies the wealthy use that nobody teaches you in school. If you want to stop giving the government more of your money than you legally have to, subscribe and hit that thumbs up, because the Roth IRA is the foundation that every single wealth-building strategy is built on. Miss this one, and everything else you do is harder. Let's get into it. Let me start with the basics, because I want everyone on the same page regardless of experience level. A Roth IRA is an individual retirement account. IRA stands for Individual Retirement Account. The Roth part comes from Senator William Roth, who introduced it in 1997. It's a special type of investment account with one massive advantage over every other account you can open. With a regular brokerage account, you invest your money, it grows, and when you eventually sell, the government takes a percentage of your gains. Could be 15%, could be 20%, could be more depending on your income. That's capital gains tax, and it eats a huge chunk of your wealth over a lifetime. With a traditional IRA or 401k, you get a tax break now, but you pay taxes later when you withdraw the money in retirement. The government is basically saying, we'll let you skip taxes today, but we're coming for it when you're 65. A Roth IRA flips the entire thing. You pay taxes on the money before you put it in. That's it. Once the money is inside the Roth, it grows tax-free forever. You never pay taxes on the gains, you never pay taxes on the withdrawals. The government got their cut up front, and now they're done. They can never touch it again. That is an insanely powerful deal, and most people don't realize how powerful until you see the actual math. Let's run the numbers, because this is where it gets real. The current annual contribution limit for a Roth IRA is $7,000 per year if you're under 50. That's about $583 a month. Let's say you max it out every year, starting at age 25. You invest all of it into a total stock market index fund, like VTI, averaging 10% annual returns, which is the historical average of the stock market. At age 35, after just 10 years, you have roughly $120,000. You only contributed $70,000. The other $50,000 is growth that you will never be taxed on. At age 45, after 20 years, you have roughly $440,000. You contributed $140,000. $300,000 of that is pure tax-free growth. At age 55, you're sitting on over $1.2 million. You contributed $210,000 over 30 years. Over $1 million of that is growth the IRS cannot touch. Now let's compare that to a regular taxable account. Same contributions, same returns. But when you sell in retirement, you owe capital gains taxes on that $1 million in growth. At 15% long-term capital gains rate, that's $150,000 to the IRS. At 20%, that's $200,000. The Roth IRA saved you between $150,000 and $200,000 in taxes for doing the exact same thing, investing the same amount in the same fund. The only difference was which account you used. That's not a small optimization. That's a house. That's 5 years of retirement expenses. That's generational wealth that gets passed to your children instead of passed to the government. That's the math. But there are 5 rules about the Roth IRA that most people get wrong. And rule number 3 is the one that trips up almost everyone. If you break it, you could owe penalties and lose the tax-free advantage completely. Stay with me. Rule number 1, not everyone can contribute to a Roth IRA directly. There are income limits. For 2025, if you're single and your modified adjusted gross income is above $150,000, your contribution limit starts to phase out. Above $165,000 and you can't contribute directly at all. For married couples filing jointly, the phase-out starts at $236,000 and cuts off at $246,000. Now, if you make above these limits, there's a legal workaround called the backdoor Roth IRA. You contribute to a traditional IRA, which has no income limits, and then convert it to a Roth. It's completely legal. It's been used by high earners for years. The process takes about 15 minutes if your brokerage has an online conversion tool. I'll explain the exact steps in a future video if you want it. Let me know in the comments. But for the majority of people watching this, especially if you're early in your career, you're well under these limits, and you can contribute the full $7,000 per year with zero issues.
Rule number 2. You can only contribute money that you earned from working. That means wages, salaries, tips, freelance income, or self-employment income. You can't contribute investment income, rental income, or money someone gifted you. Well, technically, someone can give you money and you can contribute it, but you need to have earned at least that much from work in the same year. So if you earned $30,000 this year from your job, you can contribute up to $7,000 to your Roth. If you only earned $5,000, you can only contribute $5,000. Your contribution can never exceed your earned income for the year. Rule number 3, and this is the one that gets people in trouble. The Roth IRA has a 5-year rule. Your account must be open for at least 5 years, and you must be at least 59.5 years old before you can withdraw your earnings tax-free and penalty-free. If you pull out earnings before both conditions are met, you could owe income taxes plus a 10% penalty. Here's the key distinction, though. You can always withdraw your contributions at any time with no penalty and no taxes, because you already paid taxes on that money before you put it in. The government already got their cut. So if you contributed $7,000 last year and the account grew to $8,000, you can pull out up to $7,000 anytime. It's the $1,000 in earnings that's subject to the 5-year rule and age requirement. This is why the best advice is to open your Roth IRA as early as possible, even if you can only put in $100. The 5-year clock starts ticking the moment you open the account, not when you max it out. Open it now, fund it later. Get that clock started. Rule number 4. A Roth IRA is not an investment, it's an account. This is the #1 mistake beginners make. They open a Roth IRA, deposit their money, and then it just sits there in cash, earning almost nothing. They think they're investing, but they're actually just saving in a fancy account. You have to actually buy investments inside the Roth. It's like a shopping cart. Opening the Roth is walking into the store. Buying investments is putting things in the cart. If you just walk in and stand there, nothing happens. So what should you buy? For most people, the answer is simple. A total stock market index fund, VTI from Vanguard, FSKAX from Fidelity, or SWTSX from Schwab. These give you ownership of the entire U.S. stock market, thousands of companies, for a fee of 3 cents per $100 invested. That's it. If you want to be slightly more diversified, add an international fund like VXUS. A simple 70% VTI and 30% VXUS split inside your Roth gives you exposure to virtually every publicly traded company on the planet. Set it up, turn on automatic investments, turn on dividend reinvestment, and don't touch it for 30 years. That's the entire strategy. Rule number 5. Should you choose a Roth IRA or a traditional IRA? This is the question everyone asks, and the answer depends on one thing. Do you think your tax rate will be higher now or in retirement? If you're in your 20s or 30s and early in your career, you're probably in a lower tax bracket right now than you will be later. That means paying taxes now at a lower rate and letting the money grow tax-free is a better deal. The Roth wins. You're locking in today's lower rate and avoiding tomorrow's higher rate. If you're in your peak earning years making top dollar and plan to have lower income in retirement, a traditional IRA might make more sense because you'd rather take the tax deduction now while you're in a high bracket and pay taxes later in a lower bracket. But here's the thing almost nobody considers. Tax rates in America are historically low right now. The current brackets were set by the Tax Cuts and Jobs Act, and several provisions are set to expire. There's a real chance tax rates go up in the future. If that happens, every dollar you put in a Roth today at today's lower rates is protected from future increases. A Roth IRA is essentially a bet that taxes won't go down, and historically, that's been the right bet. For most people under 40, the Roth is the better choice, and it's not close. Let me walk you through exactly how to open a Roth IRA in the next 10 minutes. Step 1. Go to Fidelity, Schwab, or Vanguard. All three are excellent. All three have 0 account minimums and 0 fees to open a Roth IRA. I personally prefer Fidelity because their app is the cleanest and their index funds have 0 expense ratios, but any of the three will serve you well. Step 2, select Roth IRA as your account type. Not traditional, not rollover. Roth IRA. Fill in your personal information. It takes about 5 minutes. Step 3, link your bank account and set up automatic monthly transfers. Take your $7,000 annual limit, divide by 12, that's $583 per month. If you can't do the full amount, start with whatever you can, $100, $200, anything. Just start. Step 4, once the money lands in your Roth, buy your index fund, VTI, FSKAX, whatever your brokerage offers. Turn on dividend reinvestment. This is the step most people skip, and it's the most important one. Your money is not invested until you buy something with it. Step 5, don't touch it. Set a calendar reminder to increase your contributions every January. The goal is to max it out at $7,000 per year as soon as you can afford to. That's it. You just built a tax-free wealth machine. Let me tie this together. A Roth IRA lets you invest after-tax money that grows completely tax-free for the rest of your life. $7,000 a year in index funds for 30 years becomes $1.2 million that the IRS will never touch. There are income limits, but most people are under them. The 5-year rule means you should open your account today even if you can only put in $1. The Roth is not an investment, it's an account, and you have to buy index funds inside it. And for anyone under 40, the Roth almost always beats the traditional IRA because tax rates are likely going up, not down. If you don't have a Roth IRA, stop watching YouTube and go open one right now. Fidelity, Schwab, Vanguard. 10 minutes. It will be the most valuable 10 minutes of your financial life. And if you already have one, drop your current balance in the comments. I want to see where everyone's at. Quick disclaimer. Everything in this video is for educational and entertainment purposes only. I am not a financial advisor, and this is not personalized investment advice. Always do your own research before making any financial decisions. I'll see you in the next one.